So impact investment has a lot of definitions, and it's changed quite a bit over the years. I think impact investment as a term really came about 10 years ago as a way to measure job creation, improvement in health and living conditions, education, beneficiary engagement, etc. It's morphed recently into ESG, which is environmental, social, and governance. So depending on who you talk to, different definitions of impact come about. But the important thing to understand here is impact investment should and never should be confused with philanthropy. A lot of investors consider donor venture philanthropy as a way of deploying capital, are often courted by impact funds saying, hey, we create jobs, but we also create return capital, pay principal back. So it's very important to understand that impact investing is not philanthropy. It could be philanthropic in the mindsets of investors as a tax write-off, but that is not the reason why people do impact investing. So most funds that are classified as impact investment funds, either as venture capital or private equity, have a commercial first goal to return capital plus something, and then have a secondary goal to say, how do I measure impact for every dollar that I've invested? How does that affect job creation, improvement in healthcare, GDP, etc.? And those criteria change, funny enough, to your second question, often because of what the investors want versus what the fund needs. And that's where the slide debate starts. So who are funds reporting impact for? One of the sort of questions we often get is, if an impact investor that funds a venture fund says, I really care about the impact of carbon, but the investee company has nothing to do with carbon reduction, is it right ethically to force a fund to report on carbon emissions when it's not something that the portfolio companies report? So it's a question of whose line is it? Is it the investors determining what impact is, or is it the beneficiaries of portfolio companies? And that's a healthy debate we can. But
Monica, I see you smiling over there, and I know that this is your range of expertise. Could environmental impact investing, what we're talking about here, do you think that it's seen perhaps as a bubble, or is it spurred on perhaps by this global ESG focus? Or could it be an emerging opportunity for Africa if we think about the mining and chemicals sector keen to invest in environmental impact businesses for carbon offsetting? And what light can you shed on what Zach just shared? Because I saw you nodding.
Smiling, yeah. So the reason why I was smiling is in my day-to-day job, I assist companies in raising capital. And so we see the trends as to where the capital is flowing. And during more difficult times, as we've experienced over the last 12 to 18 months, the areas that have really had the funding that they need is around the climate space. So what tends to happen is companies start to rebrand themselves to kind of meet this demand that they're seeing from the investor side. They're not just a company, they're a company with this twist, with this climate twist. And so they are, bending towards the need of the investor, and it feels very familiar because we did see some of this during the fintech bubble. And so the question then comes up: is a climate bubble? Are we building up a scenario where a lot of capital is going in a certain direction, and so the investors align to go to that capital? And it's not necessarily organic; it's because you're just seeking the capital that you need as a company to get the investment that you need. So.
Yeah, I'm just about to pass you on to you actually, because I was going to ask you whether you think that ESG has potentially replaced impact as a front for real development SDG goals, and please bounce off what Monica just shared as well.
I think sort of asking a yes or no question that can only be answered with yes from my perspective.
Okay.
What we see as this bubble, that is something globally where we see clean tech, ESG funds raising a tremendous amount of money over the past, let's say, 5 years. There's so much undeployed money now swirling around that obviously attracts a lot of startups, and a lot of startups that are now struggling with funding because things have frozen up. are pivoting, and I see this across regions, that everyone is trying to, okay, can I put another spin on this one? We have seen this with other things too. We also see some of the first ones with that everyone needs to add AI or something. But we're running into a problem where it's very hard then to distinguish what has really impact and what on the social, on the ecological level, and so on, and what is basically just, okay, I need money because I need to survive, or my startup needs to survive. While I personally think that ESG funds overall are good for the startup economies because they bring more money into the ecosystem. So they bring an additional source of LPs that you can't reach with an impact. So that even though impact also returns money, but the ESG is sort of another spin that attracts more investors and more money into this highly relevant and important topic is just a good thing. So, and we see some of the global push from investors that they are now looking for ESG funds still to deploy money into.
That's great. I see a lot of nods. Monica, I'm going to let you speak, and then I'm going to bring in Kendi and Melis into the conversation as well. Go ahead.
The reason I wanted to add to your point actually is on the live transactions that I'm seeing at the moment, the ones that I'm working on, a lot of the interest is from corporates. So at board level, at corporate entities, especially those that are in dirty kind of industries like mining and chemicals, they specifically have kind of carbon neutral objectives at board level, and that is spurring investment into organizations, companies that are on the continent that have kind of that ESG type climate angle. And it's a great opportunity on the continent actually, because then if you are in recycling, if you're in ag tech, anything that's really green, clearly green, then you will attract really big brands across the world in those.
But you need to be careful because there's a lot of greenwashing out there, and I think we will touch on that topic later. But overall, I fully agree that there's a lot of companies that now have at least a written commitment, and you never know how much the commitment really is.
I see a lot of nodding heads, and I want to bring us back to that definition of impact investing. Melis, I want to ask you what the misconception might be that you've experienced towards impact investing space and what you'd like to debunk.
Sure. Although, can I first answer?
Of course.
So, not to be a contrarian on the stage, but I actually slightly disagree with what all of you have said. I'm an early stage climate tech investor investing in Africa in climate resilience adaptation, and also mitigation solutions across the continent. And we've been at it for 8 years. First actually started in fintech, looked at several sectors, and then about 3 years ago really saw an opportunity in climate tech. And even if it's a growing sector, it's still only $1 in $3 invested on the continent. So it's growing, and yet it's the biggest opportunity and priority globally because we're not going to stay below 1.5 degrees Celsius. So if we don't invest in this category, we're screwed. Simply as that. And I think, we may say, of course we have to be careful about greenwashing, we have to be careful about creating bubbles, the same way that we're quick to say fintech was so important, now we're investing in something else. But if we don't invest in this today, we're compromising the future of humanity and the future of the planet. So I actually think it's a positive trend that we're mobilizing more capital. Africa needs $250 billion a year between now and 2030 to meet its climate needs. Providing it's the continent most vulnerable to climate change. So we're far from where we need to be. And I think it's only a good thing, especially in a nascent ecosystem like Africa, across all sectors, that we see more diversity, more attention being paid to the critical sector under climate, access to essentials, water, think about water issue, how we're going to feed the future, agriculture, clean energy infrastructure, right? So while we address the true impact, we also need to realize that it's a huge opportunity and a must address sector. So just wanted to say that to bring another view to the conversation on bubbles. I think sometimes it can be moving the conversation in the wrong direction. The problem is still very much here. Now, on debunking myths, the one myth of impact investing that you touched on, which I really want to debunk, is that if you do impact, you don't have financial returns. again, in Africa, you are addressing massive problems, blank slates. Like you have a huge opportunity across all sectors to build essential services that users need, don't have access to, whether it's financial inclusion, financial services, whether it's agricultural inputs, whether it's how you're going to actually provide water to irrigate your land. And there's, as a result of that, massive addressable market and massive potential for returns while you create impact. In the impact investing space, there's always this trade-off conversation. You're in a continuum. You're either here, more impact, less returns, or you're more returns, less impact. And I think what we've seen is that now the impact investing market is over $1 trillion globally, and it's being mainstream. Even the biggest financial institutions of the world are starting to think about it, whether it's ESG or a more comprehensive impact management process. And that to me, it's fantastic to see as a movement. And so, yeah, definitely that's one with that will debunk.
Okay, Theo, I'd like to bring you into the conversation as well. Given the stage, what are your thoughts on what has just been shared?
Yeah, I think it's, as being the data person on the panel,
Yes.
it's quite interesting seeing everybody's different perspectives. I think everybody's seeing it through their lens, which is obviously very accurate for everybody's different experiences. I would agree, funnily enough, with everybody on the panel with what they're seeing. I think we do have to temper our reservations in that fintech still takes the lion's share of funding coming into Africa, but it is changing in that fintech focus around inclusivity and getting the unbanked population's access to financing is growing as a segment of fintech. It pays now to solve real problems, real systemic issues, and that's where we're seeing the growth in things like climate tech, agri-tech, providing financing for the funding gap with female founders, etc. So I do think we need to temper our reservations a bit when it comes to impact investing and how we might fear that it's a bubble, etc. It's still quite a small minority compared to other funding and financing channels. There is a huge amount of growth that has stayed a lot more resilient than fintech, which is a testament to the fact that it is solving real problems that people are experiencing on the continent. And it's interesting to hear the perspective on providing returns, because I think an interesting question that we probably all have to ask ourselves is, if we focus too much on returns, are we focusing on the right thing when it comes to impact investing? Obviously returns are an element that you have to report back to your LPs, and then obviously the different bits of transparency from reporting on impact metrics from the portfolio companies, but then who is that incumbent on? Is it incumbent on the LPs to push? Is it incumbent on the GPs to fully analyze the portfolio companies that they want to invest into to understand, are they actually providing the impact that they say they will? Is it just a fad? Are they just adding fintech or climate tech to something to actually get financing? That's an evaluation that GPs have to do. If an entrepreneur's out there trying to get funding in this funding winter that everybody's experiencing, I don't think we can blame them really.
Zach, would you like to share something on that?
And just something on that, I mean, we've been doing investments in Africa for more than 10 years now. We're one of the most active venture capital funds in the continent. So the reason why fintech makes up almost 40% of our portfolio is simply because there's liquidity. You're solving real problems. If a startup is valued at $10 million, there is an attributable multiple to either transaction volume processed or revenue or daily active users. It is easy to measure where your dollar is being spent. And that could be remittances, unsecured lending, credit, peer-to-peer, investment savings. In Africa, someone mentioned here, is severely underbanked. But at every stage of funding in fintech, there are KPIs, so key performance indicators, that you can attribute that investors can understand. Climate tech is still relatively new, like 3 or 4 years at best. Let's not kid ourselves. The amount of capex and asset financing required to build a climate tech, be it carbon sequestration or an electric car, is significantly longer, right? So you've got longer lead times. I could almost compare climate tech today to what biotech and pharma was 7 or 8 years ago. So you're not going to see returns, cash on cash returns, until year 7, year 9, year 10. So the kind of LPs that you're talking to for climate tech funds will be different from the LPs you talk to for fintech funds. And it's oranges and apples. So as long as we know that, then you're okay. But let's not pretend that you can have the same messaging to a climate tech investor as you would to a fintech investor. So, and as long as you disclose this and say, hey, Mr. Investor or Mrs. Investor, if you invest, the money goes into building solar cells or building electric bikes or building, direct air carbon capture technologies, which will return money in this time, in this period, at these rates, then you're okay. The problem is when if you don't disclose this, and then you have investors saying, I backed the climate tech fund 4 years ago, where's my bloody money? Right? So that, just as long as we keep those questions consistent, then we're okay. And
Speaking on that topic, and then I want to address this to everybody, and you can all sound it, but what you just mentioned, what do you feel about the reporting requirements on ESG? You shared a little bit about it. What you have to do on behalf of the portfolio companies to your LPs. Do you think it creates unnecessarily legwork for your team? And if you didn't have DFIs on your cap table, would you still do the reporting?
short answer is no. This almost creates an entire new industry of consultants who say, hey, I can do impact reporting for you, pay me $1,000 per page, and I'll please your LPs. The reality is, ultimately, there is only one single source of truth, and that is the founder.
Yeah.
A founder of a climate tech startup can tell you without any doubt how many jobs were created, how much the GDP improved, how much the carbon reduction was. Problem is you have too many middlemen, service providers that claim to say, we can tell you, Miss or Mr. LP, what the impact was. And it's broken telephone. I think that's my...
I want to jump to a Kendi just on this one note, just based on what it is that you do with Brighter Bridges, right? Because you report, you get that data, and you can get it from the founder, but you can also get it from
service providers or...
Yes. So share me whether that's a struggle for you and whether it's something that really truly creates value for both the founders and the funders in what it is that we do.
Yeah, definitely. I think for us, so we started out as a just general market mapping company, just putting logos in different countries to show you we existed within ecosystems. And for us, that built a lot of trust with the founders themselves, the entrepreneurs that are doing the work on ground. And then that translated into investors, DFIs, whoever wanted to understand what these different ecosystems and stakeholders were doing in those different countries. I think for us, it's really important to be embedded. There are 54 countries in Africa, and we can't just focus on 4. We have to focus on the other 50 as well, and we're seeing an increase in the number of investors in those other 50, because like Zachariah said, in terms of liquidity, trying to gain a foothold in certain markets, trying to get that multiple that's so valuable for VCs in their reporting, you can't just be a small or a fish in a huge pond that is Nigeria or Kenya or South Africa or Egypt. You have to expand into other markets, potentially gain a greater foothold there, and that's where we find the most value when people are trying to understand what's going on in the other markets, because 1,010,000 service providers can report on fintech in Lagos, but can they do the same in Accra? Can they do the same in Kinshasa? All of these different areas that do need to be serviced.
Andreas, I see you nodding your head. Do you want to share some light on that?
Now I disagree a little bit.
That's why
Agree
we...
to disagree.
I think data and reporting is important. I fully agree that it's cumbersome, that it's onerous, and depending on the stage of the startup, that it's not appropriate to really focus on that one. But if we want to be taken seriously as impact ESG investors, we need to have verifiable data, because otherwise, either sort of the entire industry at one point gets switched off, or we are outcompeted by people who sort of outlie us and basically just claim triple the impact for every dollar spent. So having a framework, and one of the examples that I always have for this one is basically the entire tree planting operations that we have across the world. When there was a big investigation done, and basically they said, okay, we are triple and quadruple counting every tree that has been planted, basically, and then selling it as a carbon offset. And that can't happen, because if that happened once, okay, if this becomes a pattern, and if you can't show the data, and we can't verify the data, and the entire industry is in danger.
I agree with that. I think from what I've seen, I think it's not standardized. So the reporting is not standardized across industries or sectors, and so it's really difficult to compare. I worked on a client that's just closed out. They did a raise, and at the end of the day, the investor had to say what they wanted to see in terms of how they were going to measure this impact. And for them, it was standardized, right? So the investor has a portfolio of X number of companies, and all their companies will have that reporting, and so it becomes easy for them to see who has the greatest impact. But across the sector, there is no standard. And as he's, to his point about multiple counting and all that kind of thing, it's because there is no standard. And I've worked on another transaction where the CFO actually had to sign up for a course on how to do this reporting because he'd never done it before, right? And so because it's such a young sector, so to speak, we're in the early stages. We are deploying and measuring, and we're kind of making it up as we go along. And so, of course, it's expected that we're figuring it out. I think we're still figuring it out.
What do we do to set that standard and that accountability? Maylis, I'm going to send this to you because I see you're nodding and you're listening.
Well, on that point, quickly, I was going to say that if you want to be successful in this, proving that actually the sector grows, continues to be more mainstream, we need certainly data, and therefore we need to enhance founders' capacity for collection and give ourselves the chances, right? And so, for example, in our fund, we, alongside capital, really deploy very, very hands-on support. We call it venture building, but it can be many other funds with technical assistance. I do think that from an LP perspective, it will be very beneficial to always think, okay, if I'm requesting all of these data points, all these metrics, how am I enabling the chain all the way down to the founders to actually collect it, work on the standards, work on the framework, and give them the resources, because it's extremely resource intensive, and there's not enough of that. And there should be, I think, more investment to build that capacity, give them the resources, give them the time, even to hire an impact person in-house at every startup. Like, we can't do that as a young company. Like, when I had a startup before starting my fund, there are resource constraints, right? So that's one key thing. And the other that I think a lot of development finance institutions in particular are working on right now is alignment or standardizations of frameworks. And it's of course always difficult because it's so hard to compare apple to oranges in different sectors, different stages. At least coming up with something that the biggest funders can agree on in terms of 1 to 2 metrics that are must report, you have to report on per sector, and that are appropriate by stage, which is not done. Like, if something you ask a pre-seed company cannot be the same you ask to a growth stage Series B company, right? So I think this scalable approach needs to be worked on, and it's not there yet. Captain?
Yeah, no, I think what's interesting about the whole thing is just this idea around accountability and who is that incumbent on at every stage. Obviously, LPs will probably look to all of you to provide different bits of information for them. How they receive that information is equally as valuable as how you present it. And then for yourselves as GPs, how you align on what exactly you're measuring, because I'm sure there will be a number of startups that might collect pockets of financing from each one of you, and will you send the CFO on 5 different courses because they need to understand how to report to this GP and that GP, or is there more of a united front that needs to be established on how you expect this reporting to come from, whether it be different regions or different individual countries or cities? That's something that very much needs to be established. But I would argue again that we're still very early in this funding cycle. I would kind of give ourselves a bit of a pat on the back to get to this point. What's been quite interesting is to see the evolution of financing for Africa, the different areas that's coming from. We're seeing a number of different investors get involved in raising financing for whether it be health, and Qatar and Japan, Norfund, all of these different players are now becoming real active stakeholders in African development and in impact investing. And it's important to understand that the more diverse the pot comes, the more options that gives everyone. And yeah, I think that's something to be heralded as well.
Go ahead.
I could just throw in something here, a bit of a curveball. If there were any sort of impact funds in the audiences, unlike regular VC funds, which a lot of us manage here, if you are an impact fund, have part of your LP agreement that says, for every dollar that you invest as an LP, 30 cents of that is going to go towards capacity building and technical assistance. And that money is specifically used to help the GP team to do on-the-ground case studies, photos, videos, founder interviews, where you collect data real time. And that's not coming out of your management fees, it's coming out of your pot of money, right? An impact investor is aware from day one that I'm writing off that 30 cents of my dollar, and I get reports back, not from 500 consultants, but from the founders directly, and it's coming back to me with, and you could even build QR codes and use the blockchain to figure out, okay, if for example, sustainable farming is an important part of me, I can trace from start to finish, from farm to fork, where that came from, without having to use millions of middle managers. And then for the 70 cents that is coming from, that goes towards management, I'm looking at a commercial return. That is something that could be a way to sort of just clear the air around who pays for what and why. Just something worth looking at.
I want to ask you all a question each, and then I want to turn it over to our audience because I saw a lot of nodding heads, and I feel like a couple of people may want to ask some questions. So think about those questions in the meantime. But for right now, above and beyond the obvious barometer, which is jobs creation, what are some of the other metrics that you as prominent fund managers and investment leaders focused on the continent of Africa, what is it that you wish to see from your portfolio companies, some non-financial impact-oriented returns that you may wish to see from your portfolio?
Well, it's a hard one for me to answer because I don't have a portfolio, so to say. Given my day job, it's actually just helping companies raise capital. But what I mean, just in working with my clients, I think a lot of them in the agri space, a lot of them in the recycle space, and it's not just job creation. You can,
Right.
it's actually, especially with recycling, you can physically see where there's less plastic, right? It's very real. And obviously there's a little bit of job creation, people picking up the plastic and there's, all that kind of stuff. But it's not just jobs. I think it's actual environment that the people are living in. I don't know how you measure that. It's difficult to say how you measure it, but the impact is, it's never just one thing. It's not financial only, and it's not just cleaner air. It's literally people's quality of life. But I don't know how do you measure quality of life, right?
Zach?
I guess mine is the same in that I don't have a portfolio, but what would be interesting to see come from all of this is that those kind of ideas and frameworks that all the different GPs and startups can work within, so that there's a greater understanding of what they need to provide and what people are looking for. I would say for startups or any entrepreneurs out there is to make sure that they're telling their story to the right people, and make sure that they understand the GPs that they're speaking to, what their particular mandate is for, because it might not be for a Launch Africa or Compass, it might be for a Catalyst. Equally, they could enlist Monica to help them to raise financing, and she can identify the different pockets that are available to them. I think now it's more than ever, we need to get a greater understanding of what applies to us and who we need to speak to and get into the right rooms with those people, rather than, it's not 2021 anymore. We can't just run to everyone and get financing. We have to be really pinpointed and accurate with them.
Yeah, good point. Andreas?
I mean, we have an overarching theme of wanting people to live healthy and happy lives, basically, and we try to focus on that mostly in the built environment. And there we have sort of either quality of life in the home or building homes that are better for either the inhabitants or in the environment. And then there are a couple of secondary objectives for us, but for us, what we would like to see is basically really sort of how do you make an impact, or how do you improve processes and situations that are not ideal.
And for my sins, I used to work in Wall Street, so you can't take me out of Wall Street. I'm still very quantitative and analytical, so I'm not a big fan of soft fluff. Go back to the basics, right? Everyone here knows Maslow's hierarchy of needs, right? Food, clothing, water, shelter, etc. So you look at a continent like Africa, right? Less than 10% of people have insurance of any side. Less than 5% or 6% have any financial access to loans, credit, you name it. So for every job that is created, you go beyond just the direct job. Okay, you created a job, very good, you're the best. But how many of your employees now have medical insurance? How many of your employees can afford life insurance? How many of your employees can get a bank loan? This is real scratching the surface and going beyond just, I created 5 jobs. Because tomorrow, if my LP say, as long as you create 10 jobs per company, we'll keep funding you. But I could create 10 fake jobs. Right? So it's the quality of the job. Once you create the job, do you create insurance opportunities, banking opportunities? Do you provide opportunities where you can sell the children of the people that you employ to school? So the question really has to be a lot more deeper, and you bring it back to basics. I mean, go back to Standard 5, Maslow's hierarchy of needs, and apply metrics to it. Once we see that, then we can see true change and impact investing in companies.
Melis?
I agree with that. And I think one step further, it's very hard even for an investor to come up with one overarching metric that you would apply, especially if you have actually a quite wide, cross-sectoral approach and you're investing for very different things. Overall, our thesis is investing for a climate resilient future, and making lives more resilient and qualitative in the long term. Underneath, we have a varied portfolio that touches different things, from agriculture to water access to clean energy. And so we chose very specific metrics that we asked the specific companies to report on, and then aggregate, but not all of them have to report on everything. So for example, we track CO2 emissions reduced and avoided for those for whom that's possible. It's at the early stage. We track number of lives made more resilient to climate change in the long run, liters of water conserved, hectares of land restored or regenerated. We track obviously gender. Actually, it's a huge component for us. So what's the split between women and men and the beneficiaries that the companies serve? And that's gender disaggregated data. And then with that, we tell the impact story. I think it's also important to realize that there's not one metric, there's not one lens. You have to look at it from multiple elements, because all of it leads to the same place, right? What is a quality improvement in life? There's so many dimensions, and then sort of aggregate and tell the right impact story.
Incredible insights on impact investing across the continent of Africa. Thank you so much for joining me. I wanted to give the audience some questions, but we are out of time. So I wanted to thank you so much all for being here today. And next time.
Thank you.
Thank you all so much.